Good morning, everyone. Welcome to CapitaLand's first half 2021 financial results briefing. I'm Grace Chen, Head of Investor Relations. Earlier this week, we held our EGM and scheme meeting where we received strong endorsement from our shareholders to restructure and to list the investment management business as CapitaLand Investment. Therefore, today we are reporting the final report card of CapitaLand Limited. If you recall, just last year, it was when we first reported the impact of COVID-19 on all our businesses. So a year on, we have CapitaLand senior management team with me here today to share with you how we have fared. Please allow me to introduce them. Firstly, we have our Group CEO, Mr. Lee Chee Koon, Group CFO, Mr. Andrew Lim, Mr. Jason Liao, President, CapitaLand Singapore and International, Mr. Jonathan Yap, CapitaLand Financial, and last but not least, we have Mr. Kevin Goh, CEO of Lodging and the Ascott Limited. As usual, we will have Chee Koon to address us before we invite Andrew to share the details on the financials. We will then have a Q&A session with members of the media as well as analysts who are joining us on this virtual platform. And if you're watching us and you have a question for us, please feel free to send us your question by clicking the Post Question tab. And without further ado, Chee Koon, I'll pass the time to you.
Thank you, Grace. Morning, everyone. Thank you for joining us once again. I know we've been having a number of engagement sessions from results briefing to the restructuring that we have been pursuing. Thank you for all your support and kind attention. For the first half results for 2021, must say that the team delivered, would say, a credible set of results. Must admit that we are also in the phase of recovery and dealing with a resurgence of COVID-19 in the various markets that we are operating in. So even though, for the first half results, we have achieved a PATMI of about close to, just slightly above $900 million, almost the same as the full year cash PATMI for 2020. So credible, but we are still cautious. Over the last few months, the team has been working extremely hard. Of course, apart from getting ourselves ready for the restructuring, the documents, the approval, internal restructuring, the team has worked very hard in terms of, in terms of the execution of our strategies, whether it's in the area of residential sales in Singapore and China. I would say that's quite credible. Very focused in terms of capital recycling, launching new funds. We have launched a logistic fund in India, a debt fund in Hong Kong, and of course the second Korea DC fund, and also in the recapitalization of our Raffles City portfolio, and also the securing of a renminbi fund management license. On the lodging side, Kevin's team has also been very aggressive in terms of its growth, signing up a record number of properties to manage for third party. So I would say that all engines are firing again. So let's hope that we can continue to keep this momentum even as we proceed cautiously in the coming few months against the backdrop of COVID-19. So going beyond the numbers, apart from just focusing on delivering the numbers itself, we continue to stay focused in terms of our ESG journey. We launched a Sustainability X Challenge, very well received, got good ideas from different participants around the world in terms of pursuing solutions that could help us achieve our 2030 master plan. We launched an innovation fund to encourage greater ideas, whether it's in the area of digitization, sustainability, or new business model that could help position the company better for the future. And at the same time, we continue to help the tenants who are affected by COVID-19 measures in the various markets that we are operating in, while continuing to support the communities in Indonesia, in India, in markets where the impact of COVID-19 it's a lot more severe at this point in time. And finally, Grace mentioned earlier, just wanted to thank the investors and the community at large, for the very strong support for the EGM and the scheme meeting that we had just a few days ago. I think this marks a new beginning, but it's also today is kind of a bittersweet moment because this will be the last time that we'll be presenting our results as CapitaLand, even though we've been doing this for many years, where we share results on, both our development business and our fund management business. But going forward, the next time when we see all of you, it will be in the new entity as CLI. But I must say that as a team here, we are all very excited by what the future could hold for CapitaLand Investment and also CapitaLand Development. Both will have its own growth path. They'll find its destiny for the different entities, while at the same time mutually reinforcing each other with resources, with capabilities. It's going to be a new arrangement, but the journey of something new always offers the hope of something great. And I must give the assurance that to all of you that the senior leadership team here is committed to make CapitaLand, including CapitaLand Development and CLI, from good to great companies. Thank you. Andrew, over to you.
Thanks, Chee Koon. Good morning, ladies and gentlemen. Again, bittersweet day for us, but on the back of some credible results, we can helpfully share the final report card for CapitaLand. My first slide, I will take about 15 minutes to walk you through some of the key financials as well as the more details on how we are focused on executing the transition to CLI. If you look at the key figures here, I think they underpin the improvement in the operating environment and most notably for us, our ability to recycle capital more effectively. So you see the improvement on a year-on-year basis on the P&L and the corresponding improvements on the credit metrics, whether it is a net debt to equity or ability to continue to maintain a high level of cash and available facilities. If you look across our core PATMI buckets, that improvement is quite clear on all three. If you look at the operating side of the business, what is encouraging is the investment properties or IP operating PATMI showed again nice improvement, as well as the trading part of the business, as both China and Singapore, our core residential markets, showed year-on-year improvement in ability to hand over as well as register good sales through launches here in Singapore. As a result, you could mention operating PATMI is up about 67% year-on-year. Looking across to portfolio gains, you will remember last year we had absolutely no activity given the severe lockdowns in the first half of the year. That has been reversed and we were very focused on making up for lost time. So in the ability to recycle effectively north of 11 billion in gross value, we were able to register very strong gains in portfolio, in terms of portfolio gains for the first half. And on the revaluation side, we now have the absence of a loss taken by CICT, or at the time CMT and CCT, in the midst of their reorganization. And we had essentially a flat half in terms of having to register any revaluation losses or surpluses. As a result, first half PATMI comes in at just north of 900 million. Not much to report here as in addition to what I've already said, but you can see again the resilience on the operating side of the business, particularly for IP, tracking very well, both on a H-on-H basis as well as a year-on-year basis. Portfolio gains registering very sharp improvement, and that gives you that trajectory of continuing growth on a cash PATMI basis. On the note that Chikun mentioned up front, I think it's also important to acknowledge that while our hardest hit sectors, and we've highlighted retail and lodging here, have definitely shown improvement. So you see that H-on-H improvement for retail operating EBIT as well as our lodging operating EBIT. We are still not quite there yet, and in terms of returning to pre-COVID levels. So if you look at the gray arrows, demonstrating that we, on an EBIT basis, we are about 17% below that of second half of 2019 in terms of retail. And in terms of lodging, we are slightly further behind, about 70% below what we registered in the second half of 2019, which we are using as a proxy for the pre-COVID operating environment. So good trajectory, as I mentioned, positive recovery on an H-on-H basis, on a quarter-on-quarter basis, indicating we are on the way back, but at the same time, not quite there in terms of getting back to where we were prior to COVID. I think that's important to also acknowledge. Good news on the fee income side, which for those of you who are monitoring where CLI will come in at, we registered strong improvement, over 36% in year-on-year growth in overall fee income. If you break that down into the fund management, FRE side of things, so if you look at the Reit management and the private fund management, both of these sectors registered about 32-33% year-on-year growth, largely on the back of improved capital recycling, as you saw before. Now that our REITs and funds are back able to grow as well as recycle out of older non-core assets, we're able to generate much more healthy acquisition, divestment, and also carry for our private equity funds over the course of the first half of this year. And there you see the corresponding improvement on FMFRE of over 30%. In terms of capital requirements, the gearing is at 0.64, indicating that we have headroom at the CL level of north of 2 billion. If I continue to manage the sweet spot of up to 0.7 net debt to equity. As always, we give you a picture of what that looks like if I deconsolidate our REITs. And again, if I go back to where CLI is likely to come in at without the consolidation of CLCT and CICT, you can expect the net debt to equity to more closely resemble a deconsolidated balance sheet. Of course, we will still continue to consolidate ART and CLMT going forward as CLI. But it gives you an indication of the improved headroom that is going to be important for CLI as we continue to support our funds and REITs, as well as look for strategic acquisition opportunities. I'd like to take a few minutes now to just, again, give you a bit more details on how we're executing on strategy. And in terms of where we want to grow the business, Chikun mentioned a pivot to new economy. We've invested north of 3.6 billion year to date. So the ability to source and locate what we believe are interesting investments, both in immediate FUM, whether it's our REITs and our funds, or in pipeline for future FUM, is set out in this slide. And you can see that we've been very focused on two sectors, namely new economy and longer stay lodging. Of the north of 3 billion thus far in total investments, actually 3 billion is new economy. So a lot of that focus, again, is in subsectors such as logistics, increasing our stakes in IT parks in China, as well as some of our vehicles such as AIT and AREIT, looking to further grow their investments in new economy. So there is a concerted effort, as we've mentioned several times, to recalibrate and achieve a better balance in REAUM across our core sectors. Of the new economy investments, close to 2 billion were actually in data centers, which is again a core subsector for us. As you can see, whether it is CapitaLand or CLI's balance sheet going forward, or our REITs, we are focused on a meaningful increase in DCs, either through operating DCs or the ability to acquire brown and greenfield DCs that will allow us to implement as sustainable a product as we can develop in the near future. If I turn to lodging, I think the key word here is longer stay. So we are extending our long stay product to more of a longer stay, sort of a whale to take advantage of the underlying resilience of the long stay segment. And the two subsectors that we have identified are PBSA and rental housing. And again, here the partnership between our REITs, our funds, and CLI going forward is going to be key. Whether it is our REITs undertaking immediate FUM growth or a joint development or partnerships between CLI as well as our REITs and our funds, warehousing and incubating future FUM on the CLI balance sheet, the focus is to grow in these longer stay lodging segments. We made close to 600 million in investments year to date. The third limb of CLI's growth target is capital recycling. And as we already mentioned, we had a good first half making up for a restricted period last year. So we were able to generate north of 11 billion in gross value terms, whether that is in converting or retaining FUM. In the case of Raffles City, we retained the FUM. In the case of Galaxis, we converted balance sheet into FUM by divesting the rest of our 75% stake to AREIT. And in other opportunities where we have non-core assets, we look to opportunistically take that off the balance sheet, as you can see in the case of exiting our retail business in Japan at a very healthy premium to fair value. So this again is a key pillar of our ability to continue to effectively capital recycle. Our fund management FRE, as I touched on, is showing good progress. We are essentially at a clip that is north of our pre-COVID levels, as you can see from the left-hand side of the chart, where for the first 2 quarters of the year, we are running at an improvement in our ability to generate fee income for our fund and REIT management business. The focus again is to hit 100 billion in FUM or FUM by 2023. And a lot of the investments that we have made, I think about 75% of that is immediate FUM, with 1 quarter to be converted to future FUM going forward. We like that ratio in investing into CLI's balance sheet as partners, as I mentioned, to our fund and our REIT vehicles. Our PE platform is a core source of growth, as we have mentioned several times. And again, we are delighted to share that the first half has been very active. We have 3 new private equity products totaling over 800 million. And we've successfully registered as a domestic PE manager in China, which gives us an advantage in tapping one of our core markets in looking for domestic capital partners onshore in RMB terms. We also have launched a mezzanine financing fund, which is a new credit product for CL and CLI, which we can share further details on going forward. Lodging FRE, again, very core part of the growth of our CLI going forward. The name of the game here is scale, and we are again happy to report that for the 4th year, we are able to grow our lodging management contracts, fee income, at about a 20% growth CAGR. And this is again the 4th year we've been able to do that, or are running at that clip, boosted by over 8,000 new keys year to date in 2021. Okay, so that gives you a quick view of our focus on executing our strategy. I will just round off with some of the operational highlights going through our sectors. In terms of trading, I think in line with the overall operating environment improvements, we also saw good improvements in our trading business. In Singapore and in China in particular, we were able to again return to a semblance of where we were pre-COVID in both launches and in sales and handover. Vietnam remains a relatively quiet period, but we are looking to make up for lost time with 2 new launches targeted in the second half of the year. Turning to retail, we again see very good recovery year on year in our core markets, China and Singapore. But again, as Chee Koon mentioned, you are occasionally set back by moments or periods of time where we see spikes in COVID clusters. And we have seen both in the second quarter in China and Singapore, which resulted in either temporary closures in specific cities or regions, and in the case of Singapore, a more restrictive operating environment for retail. So I think we can expect to see similar types of start-stops whilst the overall sector improves. I think the key here again is the ability to reposition our retail product. And if you look at subsequent slides in the deck, you can see that we've been very active in recurating our retail product. We've introduced over 150 new shops into our Singapore retail platform. And in China, we've launched the Raffles City on the Bund to a very, very strong reception, again, with many new concepts which are new to either China, Shanghai, or even to the CapitaLand ecosystem. So the focus here is to ensure that our retail product remains COVID resilient and can pivot using technology and the right trade mix. Workspace remains healthy both in terms of occupancy as well as rentals. We are busy completing our ongoing workspace projects. The Cap Spring remains on target to be handed over by the end of the year, and we were able to successfully hand over a number of our business parks across in Singapore. The other projects, 6 Battery Road and 21 Collier Quay, which are AEI projects, are also on track to open on schedule. And finally, with lodging, we see much more healthy response, particularly in the developed markets of Europe and North America. If you look at the RevPAR numbers from where we were 6 months ago, you see healthy improvement in Europe and North America, again tracking general recovery based on COVID. I think the challenge there, as Kevin will tell you, is that in Southeast Asia, particularly in developed Southeast Asia, we are seeing continuing difficulties in markets which are struggling to contain COVID recovery and essentially are earning government-related contracts for stay-home notices. But the recovery is indeed underway if you look at both the occupancy and RevPAR numbers as a system. And as I mentioned, we are able to importantly convince third-party capital owners to sign up to longer stay product, generating good scale growth, which is a key strategy for CL Lodging. Okay, so that just leaves me to conclude again that we are very heartened by the year-on-year improvement in the operating and financial results that we are able to deliver to you. We still see uncertainty and uneven recovery in various markets that will open and close based on how we deal with COVID across our markets. But we remain committed and disciplined to deliver on the endorsement that our shareholders have given us following the successful conclusion of our EGM. Thank you very much. Let me turn it back to Grace to moderate through questions that you may have.
Thank you, Andrew. We'll now proceed to Q&A. We have on our virtual platform sell-side analysts from 19 research houses and journalists from 6 news media outlets. Before we take the first question, we'd like to remind our guests to please introduce yourself and your company for the benefit of our audience on our webcast. And also, if you are viewing us via webcast, you have a question for us, please feel free to send it to us by clicking the Post Question tab. And with that, we'll take the first question. We'll have Tan Shen from Goldman. Shen, please.
Hi, morning. I have 3 questions on buying platforms to grow AUM. Firstly, has ESR's acquisition of ARE changed how you think about platform acquisitions? And secondly, will you also skew towards new economy platform, and how much premium do you think it is worth over other form of platforms? And lastly, how do you view the combined entity as a competitor for CapitaLand for third-party capital? Thank you.
Hi, Chee Koon here. Thank you. Good questions. we'll definitely be looking at platforms, and I think I had earlier mentioned before in the investor briefing that if we were to buy platforms, there are a few criteria that we look at, whether it's going to give whether it's going to be strategic for us, meaning that it's going to add new capabilities for us, whether it's in terms of new products or new markets. So these are important criteria that we look at. In terms of the premium to pay, I think there are various issues to think through. Again, if it is a strategy, it's a ability to help us generate a lot more fee income than the premium that we are paying, then I suppose it is fair. But if it's not going to be the case, then it's going to be difficult for us to continue with. So it will be the same level of analysis as we look at new M&A, whether it's going to be accretive. May not be immediately in the short term, but if in the long term it makes sense, it's strategic, it's going to help us to create a lot more product and build up a lot more capabilities. I think that's something that we will pursue.
And how about the combined entity as a competitor for third-party capital?
I believe there will be increasing competitors in the markets. There are different strengths. I think they have built up good capabilities on the logistics side. There are also other competitors in the market, whether it's in Australia, whether it's in Europe or in US. So we expect competition to strengthen. The important thing is we need to be clear in terms of our strengths, our offering, our capabilities that we are building. I think the market today here, it's the market condition is such that I think it's more it's important to have teams on the ground to be able to find products, to find off-market deals, to originate ideas. I think the market today is indeed flush with liquidity. If you have good ideas, good products, I don't think it's so difficult to raise money at this point in time.
Thank you, Shen. We'll have Yu Kyung next.
Hi, can you hear me?
Yes.
Yeah. I also have three questions. Firstly is, can you talk about the operating PATMI for first half and 2Q, excluding the development business? That's the first. Second question is, can you remind us of the dividend policy for CLIM? Third question is on the private rental business. Currently you have 600 AUM year to date. Can you remind us what is the current total that you have invested in this space, and where do you see this over time? And I assume that ART will continue to be the exit vehicle. Is that right to assume?
Hi, Yu Kyung. Let me take the first two, and then I'll
Yeah.
pass it over to Kevin to talk about rental housing. So if you turn to page 11, there is a breakdown on the operating PATMI between the IP and trading.
Oh.
Yeah. So you can you'll see that you get the your characteristic seasonality for trading, shall we say. You will know that our trading business tends to be back-ended into the second half. It's not by design, but it's just one of those things. I suppose when you start in the year, you figure out when you're going to hand over, you figure out when you're going to launch. It tends to be pushed to the second half. So we generally get stronger trading results in the second half of the year. That's just the way it's worked out. And so you see, again, improvement, right? 71 up to 105 when I look at first half of 2020 versus first half 21. Better launches, ability to launch, ability to hand over in Singapore and in China. I think that's consistent with what we've seen in the market. Then when you look at the investment properties, very, very encouraging, resilient improvement. Also very much founded on the operating environment. And I would like to think provides a picture on the recurring nature of that operating PATMI for IP. So I hope that gets you a sense of the trading versus IP split. On dividends, no change to policy, 30% minimum of cash PATMI for two key reasons. One, to provide our shareholders who are hopefully coming across to CLI with that familiarity. But also given the uncertainty that we still see And for two of our core sectors, retail and lodging, not quite being back to where we are, but recovering nonetheless, we wanted to build in some level of prudence and to take a conservative approach in being able to deliver 30%. Historically we are 40+% of cash PATMI, and we take a couple of cycles. If CLI is able to continue to recycle well, grow well, generate good cash, recurring cash PATMI, we will be in good position to review the dividend policy, and with the hopes of, I think, raising the floor from 30%. Hope that's okay. Let me turn to Kevin on corporate housing or rental housing.
Hi, maybe just to take a look at the profile of these longer stay assets that Andrew has mentioned earlier. So rental housing, if you look throughout COVID, we've been operationally achieving an occupancy of above 95%. PBSA, the one that ART bought earlier this year, is already 100% pre-lease, for the next full year. So we like the profile of the longer stay assets. It gives us a lot of predictability, lower volatility, and a very constant cash flow. So as to whether ART is exit vehicle, whether ART will do more, I think then it's a question of balance and accretion, right? So we want a portfolio that's resilient throughout, cycles, and also we'll be acquiring assets that are accretive to the existing portfolio, right? So I think that's probably how we'll think about lodging assets in the context of rental housing and PBSA. And we're definitely looking to do more. It's an asset class that allows us to build funds, whether it's private funds or public funds around.
We have Joel Siu from DBS asking, what is CapitaLand's strategy for the data center space? Would you consider it a core competency you would like to develop, or would you partner or acquire a company to gain that skill set?
Thanks for the question. I mean, data center is an asset class that we want to grow. I think Andrew earlier mentioned that we have deployed significant amount of capital in India, in China, and in Europe just this year itself. So we want to continue to do it. If there are good operating partners that we can partner with that can help us to further propel the growth trajectory of the data center business, we will definitely review and look at it appropriately.
Thank you, Chee Koon. We're receiving questions from analysts as well as members of the media via our virtual platform. Let me just read out a question from Yu Kiang. What is the AUM? Sorry, I was just going back to Kevin. What was the AUM under PBSA?
So to Yu Kiang's question, I think rental housing, we've got two parts, right? One's portfolio in the US. I think that's about $600-700 million US. We've got about 2,000 units under ART. That's Japan rental housing. I think that's public information. We can get it from the ART report. And then for PBSA, I think we've just started. We've invested one that's serving Georgia Tech in the US. And we've gone into a JV between sponsor and ART for one property in South Carolina. Right, so it's still a bit of early days, but we're definitely looking to deepen AUM in these sectors.
Thank you. I think we'll move on to Derek. Derek Tan, please.
Hi, morning. Can you hear me?
Yes.
Okay. Hi, morning, Chee Koon and team. I just have two questions. I think going back to Tan Shen's earlier question on, say, AUM, right? I'm just curious, if you could give us some color on where do you think possible bolt-on acquisitions or geographical kind of exposure that you think will complement the overall group exposure. I think it's in view that there's a big chase for capital. I mean, ESR, ARA is one. You see Capital, buy up SPH. So your peers are also trying to catch up. So I just want to hear your thoughts on that. Second one is on lodging. I think while we look at PBSA for stability, but I think there's also a lot of growth in your SRs, right? So the growth trajectory in second half will be strong. Maybe can you give us some hope and optimism about second half and going to 2022? Yeah, that's all for me.
Thanks, Derek. Andrew here. Let me take the first and then maybe get back to Kev on the second. So when we talked about our FM strategy during the run-up to EGM, one of the things we looked at was where we have historically been active in and the gaps or opportunities, maybe I should say, of where we can go to. So we look at our product, our REIT product and our private equity product historically, very core and focused on sectors which we were strong in the past, right? As we move into CLI, we've identified that we can go into, in addition to core, we want to get into value add and opportunistic. In addition to our historical sectors where we had strength, we want to grow into new sectors, new economy, alternative assets. And these are very, very large sectors and are presenting opportunities, not just your usual set of opportunities, but given what is happening in credit tightening, in companies that are now increasingly looking for capital partners, we see an ability for us to leverage our presence in the core markets with boots on the ground, with experienced teams, and to put out product that is exactly to fill those opportunity gaps. So if you look at the PE funds, maybe I should let John spend a bit more time illuminating on how you see the new funds fitting into that opportunity set. It actually is quite clear to see, but perhaps John can share more information.
Hey, Derek. Hi, Derek. I'll probably take the question in a bit more general sense. I can understand with all this recent announcement is obviously very top of mind, and obviously as you guys trying to build up your model, you like to basically try to compare across the board. But the starting point I'm going to say is these are essentially, I would say, consolidation to some extent. They are not vehicles that are newly created. These are existing vehicles. So I don't think these are like, in a way, competition fresh, but nonetheless, obviously get the question, which is because it's all of us are trying to bulk up. So obviously some of us probably are run a little bit harder than maybe some others. But I do think that's a good development for the entire industry. As we all know, this part of the world, real estate investment managers, asset managers are probably a sector that's not very well covered, mainly because there are probably not too many investment products available for investors broadly. So with this development, I believe it will then bring more investment capital to this part of the world, specifically for REIM. So I think that's really a great development. And from where we stand, as we have said in the past, we will want to grow by growing our existing funds. We also want to grow by creating new funds. But at the same time, we also want to grow by basically seeking M&A opportunities. And when we look at M&A opportunities, all the reasons that Andrew mentioned earlier as to how well a new vehicle will basically complement our existing vehicles is obviously important. But at the same time, what is also important is that what does it do to our returns? So then we have to see whether the vehicle that we're buying, when in terms of the fee income stream that comes with it, how long the duration is going to run, is it complementing with what we have, and what is a reasonable payment to make for that income stream. So I think that's important. I think that's where we stand quite nicely with a very nice base in the REITs that we already have today, give us a very solid income stream that runs for a long time. And at the same time, we also want to basically add alpha to the kind of return profile we get by adding on potentially more private fund products and obviously, hopefully, potentially M&A opportunities in those areas. So I think really from where we see is about more important, what is more important is how does it further strengthen to the base that we already have today. Thanks, Derek.
Thank you, Derek. We'll have Brandon next.
I think there's a question on the lodging, right?
Apologies.
So, Derek, thanks for your question on service residences. I think you're absolutely right. It's actually I personally like the product because we can flex the demand in both the short stay space and the long stay space, right? So even within our portfolio, we see hotels dropping to 10% occupancy during the depths of COVID. But service apartments continue to run at 40-50% occupancy, giving us actually quite positive or, at worst case, neutral cash flow. So we see recovery in the market, and during COVID, we've been flexing more towards the long stay space. We see our portfolio flexing a little bit more to the mid and short stay space, especially with in countries with big domestic markets, right? So to give you an example, in Europe now, in France, in Germany, we're seeing occupancies of about 70 to 80%. because domestically they are traveling and we see good demand there. China was performing very nicely for us. There was a outbreak recently, but we're hopeful that that will be contained very quickly. Same thing in Australia. Australia has a good domestic market catchment, performing very well. The recent outbreak, again, I am hopeful that it will contain itself. So overall, I think if you look at the quarter-on-quarter numbers, the RevPAR has gone up quite nicely, and I do hope that with vaccinations progressing, relatively quickly in many of the markets that we operate, we should see a much better 6 months ahead.
Thank you. We'll have Brandon, please. Brandon.
Yeah, hi. Morning, Chee Koon and team. Just 3 questions. The first one is, can you give us more details on the Southernwood JV as well as the PIC investments funds that you just created? Like how, in terms of fees, AUM, how you're going to recognize them and until how long? And second question is, can you just guide us through how much capital has been utilized for the Credo 1 debt fund so far? That's my second one. And third question would be, if I were to look at your second quarter lodging management fees, I think it's about maybe 35 million. So is that a pretty viable number to look at on a stabilized basis going forward on this 70K of operational units? Yep, thanks.
Hi, Brandon. I'll take the first 2 questions. I guess the third again will be Kevin. Southernwood JV is basically a JV that's holding 79 Robinson Road. So that's actually doing pretty well. As I mentioned previously, occupancy is already just a tad lower than 90%. So obviously, given the scarcity of the remaining space we have to lease, we obviously are also curating the remaining tenancies for the last 10%. So I think it's in a very good spot. So we're quite confident. I think it's quite nicely. I don't know whether is there an underlying question you're trying to ask that we're going to do with it. At some point, yes, we will sell the asset, obviously to one of our funds. If that's your question, Brandon, we will obviously be planning to do that. But I think now what we want to do is to make sure that we fully leverage the opportunity that comes with the last 10% of the space we can lease, because these are really nice remaining spaces. We want to make sure we do justice to it. Your question on PIC is a private fund that a private venture was started to basically fund a residential funding opportunity that we found in Hong Kong. So that one, since then, we have already kind of like sell down more than about 70% of that position. So it's just like any other fund, except it's a single position vehicle. Credo is a fund that we have yet to deploy capital. Obviously, for the reason that we want to make sure that we best match the investments returns as well as investments that we're going to make with that of the investors' objectives. So, but as you can see, the fact that just because we've got one existing arrangement going, it doesn't mean that we'll not do other arrangements that probably will make sense in other situations that perhaps other investors may like. So that's something we're going to do. We're literally going to have all engines fire, and at the same time make sure that the best match will basically be facilitated for each of the specific situation. Hopefully that answers your question. And Kevin?
Yeah, Brendan, the second quarter numbers are definitely not representative. I think the global markets are all depressed because of the pandemic. Something that's more representative would probably be 2019 numbers. Right, so if you look at 2019 numbers, our experience in terms of the fee income will be for at least stabilized service residence units. We are getting about 20-25 million on average for every 10,000 keys. So I think that would give you a good guide as to what's a normalized situation like. Right, so this year's numbers would look depressed, and we look forward to better numbers next year.
Okay, thanks a lot.
Thank you, Brandon. We will next have Louis Chua. Louis?
Hi, morning. I've got 3 short questions. The first is in terms of slide 21, the FRE growth, the 29% year-on-year increase in the first half. If you could just give us the breakdown between the higher transactional activities versus the base fees, performance fees. Second, in terms of the 3 new funds where you raise new equity from third parties, just want to get a sense of this 800 million how much would CapitaLand's equity investment be versus from third parties for these 3 new funds? And lastly, if I just look at the overall picture for the 27 private funds that you have about 15 billion of fund size. Just how much of this would be already invested or committed versus those which are still pending deployment? Thank you.
Thanks, Louis. Andrew here. Let me take the first one and I'll pass it to John for the subsequent questions. It is largely is one-offs, the improvement in fees. Obviously, you had a bit of FUM growth as the REITs were organically growing. So you had a little bit of base fee increase. But if I break that down, if I go to slide 13, right, the REIT management fees improved from 104 to 137. Mostly all of that was, or the vast majority of that was on acquisition and divestment. Similarly, the private fund management fees went from 37 to 50 million. Almost all of that is on performance fees on divestment. So if you think back to where we were last year, first half of last year, very little capital recycling going on. So the REITs and funds were not able to generate the performance and one-off fees. That has been effectively reversed because we were very active in first half of this year. So that improvement, I suppose, gives you a sense of where you've got a recurring base, where you're earning the AUM of your base fee of your AUM. But then if you're able to recycle capital effectively, both on the acquisition, divestment, and in some cases moving capital from one product to another within the CL ecosystem, then you are being very efficient in generating acquisition divestment fees. Thanks, Louis. I'm pass it to John.
Thanks, Andrew. Maybe I'll just supplement a little bit on the first question before I move to your second question, Louis. When we look at transactions, of course, it brings about transactional fees upfront. But when it comes to investment, what it also does is it also contributes to the base fee for the subsequent year. Because unless the investment is made, say, literally on the first day of the year, actually the contribution to that particular year where investment was made, effectively you will not see the full effect. So what we see in the growth in the base fee as well as the performance fee for this particular first half is also reflecting some of the transaction that was done last year. But because it wasn't contributing fully into the first half last year, so the effect is amplified to that extent. Now, to your question, for the 3 funds, actually our stakes varied quite a little bit. I'm going to tell you what they are and also rationalize for you why they're a little bit varied. For the DC Korea Fund, we do not have any stake in it. We're just basically the asset manager for it. So we basically are running the fund and the operation. For the debt venture that we have, that's the PIC. That we basically currently hold about 30%. We probably will reduce it a little bit more progressively. For the India Logistics Fund, we hold 50%. Now, why we have a bit of varied is obviously a function of a few things. Firstly, I guess investors' interest, also a function of our desire to basically also partake in investment returns. There will be some situation where ideally we would like to hold, say, 20 to 30% so that we can have a balance between fee income as well as investment returns. There will be a situation where perhaps we think the upside perhaps makes sense. We're happy to take a little bit more. Or there are also situations where investors just like it so much that we just have to basically put their interest ahead of our interest first. So therefore, as a result, there are cases that we obviously gave our investment stake to some other investors who probably like it very much. So that's the reason why you see the varied numbers. Thanks.
Okay, we will have Wilson from Morgan Stanley.
Hi, morning everyone. Just to follow up on, I guess what Louis was asking on the fee business. So Andrew, I think you mentioned the improvement in fee income appears to be mostly one-off for the first half. Does that mean that as you get to the second half and beyond, that that growth will start to normalize downwards? Maybe not 30% year on year, but more the growth rate more in line with the growth in AUM or FUM. And I guess the second related question on FUM is that growth rate. I think it grew by about 2 billion in the first quarter, another 4 billion in the second quarter. Where did that growth come from? Is it mainly from the new fund launches, or is it or how much is contributed by appreciation in the underlying assets within those funds?
Thanks, Wilson. It is, to answer the last question, is generally on growth, less so on revaluation of IP, as we've only had a short period of time. So if you think about FUM growth, we grew FUM by about 7% year on year. And we've indicated that historically, if you look at the EGM deck, we were able to grow FUM at a historical clip of 10 to 11%. So I think we are tracking the organic growth in FUM well in 2021. And that should give you a sense of what the normalized growth in FRE should be. Because if the FUM is growing at a 10% clip, that FRE should grow with it. And I go back to John's point about structuring products that allow us to generate higher percentages of FRE, given that we are moving from what I would say more traditional vanilla product in core and in our older sectors to more bespoke, more in-demand product, given where we are today in a post-COVID environment and what LPs and investors are looking for. So if we can put out product that is in demand, it is interesting, it is more bespoke, perhaps higher on the risk return, then the ability to structure that product also brings with it the ability to earn better FRE. So I would say that yes, your one-off acquisitions coming from a low base will normalize. That's, I think, probably true. But if you're growing FUM at a 10% clip and you are structuring products that allow you to earn better fees, then that percentage of FRE should also improve over time. Thanks, Wilson.
Thank you.
Thank you, Wilson. We'll have Mervyn from JPM. Mervyn, please.
Thanks, guys, for the call. Just a few questions. So starting with the lodging business, 53 million operating EBIT. Just wondering where you give us some color in terms of the geographic breakdown. Is there any areas which are loss-making, which may turn to profitability in the second half? Just in terms of M&As for platforms, maybe you can share with us your valuation framework. Is there EV, EBITDA, or PE range that you think will be reasonable going forward? Is 18.5 times EV, EBITDA reasonable? And then finally, any color in terms of performance of ION and the US multifamily? Thanks.
I'll take the first question on the lodging EBIT. I think for the first half, it's mainly anchored by China. We've been doing very well in China in the first half, and supported by markets like Australia, a little bit of Singapore. First half, I think North America and Europe is pretty much still locked down, but we see that turning around in the second half. Southeast Asia, a bit patchy. We were doing pretty well in Indonesia in the first half, but there was a big outbreak, and then business was curtailed. So generally, I think the way to think about it is to look at really the rate of vaccination in various countries. Those with higher rate of vaccination generally can have more normalized business activities, and that really helps our business, right? So I think if you look at the rate of vaccination, it gives you a good idea of where things might improve going forward.
In the question in terms of valuation framework for asset management platform, we'll use EV, EBITDA, we use PE multiple. I think fundamentally we need to be very clear what is the criteria, again, how the asset management platform is going to add capabilities, ability to originate funds, products, and ability to add fee. And is it going to be earnings accretive for us? Maybe not in the short run, but in the longer run. So all these are questions that we will think through. I want to emphasize that we will not pursue M&A just for the sake of bulking up the AUM. That's not the key that we are looking at. So the important thing is we need to make sure it makes sense. It has a bigger fit in terms of the strategy for CLI going forward.
There's a question on ION, so I'll take that question. I think fair to say ION, as you know, is a retail mall. I think we're just make sure that we want to stabilize the performance. As you can see earlier, sales and traffic, they actually tell a slightly different picture. And I'm going to guess the underlying question again is what are we going to do with the asset when we're going to sell it? So I guess at the right time we will. But I think the main focus now is to make sure that we stabilize the performance. And we do see that, as you can see, even in Singapore numbers that Andrew went over earlier, while traffic came down, actually sales, in fact, traffic gone up, but the rate of increase for sales gone up even faster than the traffic for Singapore. I think that's probably where I think things are a little bit more interesting these days. When you analyze performance, you probably have to then decide what are the indicators, probably not just traffic in the case of retail mall now, and that's when the online, offline becomes a lot more interesting. So from our perspective, I think once we kind of stabilize the performance of the asset, we will think about what's the best thing to do. If I may just very quickly also supplement what Chee Koon just said on valuation matrix. I think other than all those that were mentioned, just like when we look at asset performance, we look at whether it's accretive, whatsoever. We also look at the whale. Likewise here, I think when we look at the income stream we're going to buy from a particular M&A opportunity, then we have to see how long the stability, how long the duration of the income stream, and the quality of the income stream. Not very different from how we analyze the asset. And that's the reason why I think it's very hard for us to tell you what range makes sense, because it all depends. If you have a vehicle that probably give very, very long duration income stream fairly certain, then obviously deserve a better valuation matrix than perhaps something where you see most of the income stream is going to fall off over the next 1 to 2 years. So therefore, I don't think you have just an indicator to tell you what is the right number. So with that, I'm going to pass over to Kevin on the multifam question.
Okay, I'll just quickly touch on multifamily. I think when we bought the multifamily portfolio, there was a value add thesis attached to it, right? And I think at the moment we're still working through that AEI works. I mean, if you've been tracking the multifamily cap rates in the US, it's been compressing nicely. So I think that portfolio should be in a good place. But we want to work through our AEI plan first.
Thanks very much.
Thanks, Mervyn. We'll take another 2 questions, one from David and then Vijay, before we close off the session. We'll have David first. David from Daiwa.
Sure. Good morning, everyone. Is there a way that you could disclose the breakdown of PATMI between CLI and the private vehicle?
Thanks, David. There is no way, but I can. Let me try to give you some data points. So, in anticipation of this question, we looked at the NAV/PS. So, if you look at the NAV/PS of CL, we were at 430 December 30th. We paid out 9 cents dividend. Let's not forget that, and we are at 442, right? So we've got 19 cents of NAV growth of CL. If you look at CLI and what we've published, we December 30th, we are at 282 in the NAV/PS of 1 CLI share. And on the pro forma first quarter, that is 286. And if you include all of the transactions we have announced to July, that is 292. So you can do the math and try to triangulate, or it gives you an estimation at least as to how that NAV growth of 19 cents at CL is attributable indirectly to the CLI business. Hopefully that helps. Maybe I'll give you another sense. If you look at the capital recycling that has happened in the first half, the 3 main ones I can think of are Olinas, or our Japan retail, RC, our RC portfolio, and Galaxis. All 3 are CLI assets. So the NAV growth on the portfolio gains generated from all 3 will attribute to CLI.
Okay. And just a quick follow-up. You mentioned a dividend guidance of 30% of cash PATMI. If I look at the first half results, almost or all of it is cash PATMI. So, it seems like, that's locked in for shareholders of CLI for 2021, right?
Yeah, I mean I think we did mention that for CLI, we have committed to a policy of, I mean, sticking to the same policy as CapitaLand for two reasons. One, it's just to make it clear in terms of policy, as we are transiting, from the CapitaLand to CLI, keep the policy the same. The second thing is really to look at how the COVID situation is unfolding, whether there are needs, whether in terms of supporting whether tenants or any of the business entities. So we just wanted to take a more conservative approach in terms of communicating that policy. But that does not mean that, I mean, usually if you look at the history, even though we commit to 30% cash PATMI, we generally pay out a lot more than that. And I think the other useful thing to think about issue is that for CLI, the idea is to be an asset-light vehicle. So these are the considerations that we will have as we think through and make a recommendation to the board on what the dividend should be going forward. Thank you.
Thank you.
Thank you, David. We'll have the last questions from VJ.
Yeah, hi. Can you hear me?
Yes, VJ.
Yeah, good morning, everyone. I just have a couple of questions. My first question, I would like to track back to some of the impairments made at the end of the FY 2020 on Lifang. Specifically, this was an asset which was marked as non-core and on sale. Maybe can I get a status update on this? And also on the impairments of Quest as well as the Chongqing site. Was there a write back during the first half of the year, considering that the market conditions has improved? That's my first question. My second question is on, can you give a breakdown of the portfolio gains recorded this first half between divestment gains versus the fair value gains? Was there any valuation increase in this portfolio gains? That's my second question. Thank you.
Thanks, Vijay. On the impairments, no change to Quest and RCCQ. On Lifang, because it's a mark-to-market investment now, we actually recorded a small increase because the value of Lifang improved in the 6 months. So I think a single-digit improvement in million dollar terms in mark-to-market. So hopefully that answers the first question. On the second question about the breakdown of portfolio gains, are you referring to the crystallized reval in anticipation of the closing of the transaction? And in terms of breaking up the portfolio gain? Okay, so the bulk of the second category is in the Raffles City divestment, where we have marked up the fair value of the Raffles City portfolio to the transaction price. And I think the premium was something like about 6.7% of fair value. So that part of the reval uplift is booked into the portfolio gains in anticipation of the crystallization of the closing of the transaction in the second half of the year. The rest of the assets are more or less are transacted. So Olinas was transacted, Galaxis was transacted, and the other assets that that we have also announced in the first half essentially are crystallized portfolio gain.
Got it. Yeah.
So
that's all I have.
The realized reval, which I think is your question, is mostly coming from the announced transaction of the Raffles City partial sell down, which has yet to crystallize. A portion of that has been booked in the first half. There will be another portion hopefully coming in the second half when we close the transaction.
Got it. Thank you.
Thanks, Vijay.
Thank you, VJ. And because no questions have been posed to Jason, Jason will be heading CL development going forward. Won't be seeing him at a CLI conference. So I would actually invite Jason, maybe you want to say a few words about, your vision for CLD before we get Chee Koon.
Thank you. No, rest assured, CLD will be a very good partner of CLI. I think we have make it very clear that we are very serious about retaining the ecosystem and the value proposition of the current CL. So CLD would undertake development work. Hopefully we can build up a pipeline for CLI to launch some of these fund products. So if you are still interested in buying properties, just want to do a bit of advertisement on the redevelopment of Liang Court. Canning Hill Pier is going to be launched sometime in September. So for those who are interested, can always call me and and you can give you a preview of the show flag. Yeah, thank you.
Thank you, Jason. I'll invite Chee Koon to give some closing remarks for CapitaLand Limited before we close off the session. Thank you.
Just to thank all of you for the time and all the patience and all the support that you have given us. Really looking forward that when the vaccination rate goes up, we can do this in person. Nothing beats having to to explain and to have the dialogue session and to face to face, and instead of continuing to have to do this on virtually. Thank you, everyone.
Thank you, Chee Koon. And with that, we'll close off the session. Thank you again for joining us, and we look forward to meeting you again as CapitaLand Investment. Thank you.